This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the continued support and for tuning in. If you like what you hear on Planet MicroCap Podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the show and join the microcap investing community. Registration is now open for the Planet MicroCap Showcase Toronto in partnership with MicroCap Club, happening October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll want to be there. Visit planetmicrocapshowcase.com to register. See you in Toronto. Now, my guest on the show today is Iggy, better known as Iggy on Investing, a deep value investor and blogger. In this episode, Iggy shares how the COVID-19 lockdown gave him the time to dive into investing, turning inspiration from Buffett and Graham into a disciplined, deep value strategy focused on small, illiquid companies trading at substantial discounts to book value. We discuss his young Buffett style approach, seeking firms at 0.3x to 0.5x book with strong ROIC and catalysts, especially in overlooked European markets, as well as the role his blog plays in clarifying his thinking, building conviction, and holding through long, boring periods. Iggy also walks us through hard-learned lessons, from the importance of staying within your circle of competence and scrutinizing corporate governance to navigating shareholder activism in a quote-unquote stag hunt scenario. And he shares how he's building an investor community in Europe, including hosting his second annual Benelux, I'm sure I'm butchering that, so I'm going to try one more time, the second annual Benelux Investor Event on Saturday, September 27, 2025. For more information to register, you can go on his Substack. That's iggyoninvesting.substack.com. Thank you again for tuning in to the Planet MicroCap Podcast, and please enjoy my conversation with Iggy on investing. Iggy, thank you for joining me today. How you doing, man?
I'm doing very well. Thanks for having me. Pleasure to talk to you.
Absolutely. It's great to have you. And I'm just going to say right now, for those watching on our YouTube, this is the greatest mustache I think we've ever had on the Planet MicroCap Podcast. It's just full, just perfect. Look at that thing. That's amazing. But look, Iggy, I've been a follower for a while, reading the blog and everything. So I apologize for this being, long overdue at this point. So I appreciate you coming on.
No worries. If you would have had me on a year ago, it would have been way too soon. I'm still learning in public. That's also what the blog is about. So, just thanks for having me. And I think the timing is perfect.
Absolutely. No, listen, we can learn together right now. We'll talk through a couple things. Maybe we can learn more about each other. We can really do a deep dive therapy session and see, where we end up or not end up nowhere. It's about the journey. Anyways. So, love to start off. This is the main question I ask everybody to, kickstart things here, but love to know where your passion for investing began and then how you got to where we're currently at today.
Yeah, so I think my passion for investing started, as for many people who are a bit younger, around 2020, because suddenly you had a boatload of time on your hands to finally teach yourself some of the stuff you've been wanting to get into. Because I'd known, for example, about Buffett, right? He was already very, very famous when I was young. But I think I might have even already read The Intelligent Investor. I had it on my bookshelf, but just never got to it. And then during 2020, I finally had this sort of impulse to start learning about it. And another thing that happened is that I had quit my previous student job, I think right before Corona. And then the other thing I did with my time is I sent a lot of open letters to a lot of companies to see if I could get a job. And I got a very, very funny job at a private bank where I basically helped them do lead acquisition by sending cakes to clients. So nothing financially based, but it was a very funny sort of side job to do. But through this job, I met all these private bankers that had some spare money. I sat with them in a room, and 50% of the time, a bit more hopefully, they were talking to their clients, and the other 50% of the time they were gambling their money away in the market. And I realized wait, so this is what retail investors are really like. I think Buffett might have something to say with markets are not that efficient. So I think the combination of having time to study actually and teach yourself some stuff and seeing how the actual market participants behave sometimes gave me the sort of confidence to start investing.
Awesome. Yeah, listen, I have to ask though, what kind of cakes were you sending out?
Anything. They were willing to pay big bucks for the cake, so we just got the best local baker in any village, and I just had to call them up with, please send a cake to here and here, and the invoice will get paid, so don't worry.
Nice. Did it work? Did it actually convert a few folks, or did it? Or...
Yeah. I mean, if you, for big account stuff like this works, right? You send them something personal, and of course, what you should not forget is in these sort of big emotional financial decisions, maybe the wife also plays a role, and I think the wife really likes the cake.
Did you ever have a moment where you accidentally got the wrong name on the cake? So that they're like, wait, who's this? This isn't Gustav's house. Like, what are you talking about?
Yeah, wrong house for sure once or twice, because there's sort of a way in the Netherlands to guess where somebody lives, but it can be wrong. And I had one or two typos where my boss got angry that I spelled the company name wrong or something.
By the way,
perfect.
I use my working name as my to be local with it. Is Gustav is it's a local name, right? Not a lot of Gustavs now.
No. We're big with the Jans.
Jans, I should have said Jans. Dang it! Oh,
Jan works everywhere in Europe. Gustav more the north and the east, I think.
Oh really? Oh dang it! Oh okay, all right. That's good to know for next time I need a Netherlands themed type joke. Okay, that's good to know.
Yeah.
So okay,
actually Yankees, if you know Yankees. So
I don't know that one.
From New York are called is because there were a lot of Dutch settlers there, of course, called Yankees. So Yankees is actually sort of a ruining of a Dutch name, Yankees.
Well, that happens to be the name of my favorite baseball team, so I'll yeah, based on how this season going, it's like oh, that's very appropriate right now. But anyways,
okay.
So it sounds like really you obviously you had a little bit of time on your hands. You're seeing like, okay, these guys are bankers basically, and that are people are entrusting with their money to manage or just keep secure, safe, all that. And here they are investing in the markets in a very how we should say laissez-faire way, so to speak. Yeah. And so
they're private money, by the way. They were not gambling away.
Right.
Their own bonuses were different pay.
Right, but what I love that what you gleaned from that was that, hey, I can do this too. Like these guys are supposed to be the professionals, and they're just taking shots with their own private money. So that's really cool that you were able to be like, all right, I could probably do this based on what I'm seeing here.
Yeah, exactly.
Very cool. So how did that translate then? So, okay, you saw I can do this. What did you deep dive into? Did you finally read The Intelligent Investor? Was that the first step, I'm assuming?
Yeah, I think a lot. So for sure, The Intelligent Investor, and I think you must have remembered because you were probably already active in the space. I think the financial YouTubing space was very, very active in 2020. So
very active.
There was a lot of people to listen to. There were a lot of books recommended, infinite amount of podcasts by Monish Purbright to listen to, Old Berkshire meaning. So lots of books, lots of self-learning. And I think one of the things I thought at the time, and I still think, and I think we're 5 years later now, is that the market seemed to be in a bit of a frenzy when it came to the large caps, because all the stimulus and all that. So I decided, well, what did young Buffett do? You look at smaller illiquid companies, discount to book, etc., which I think has worked decently for me, but ignoring the large cap stocks, of course, over the last 5 years has not necessarily been the best decision. And basically like that, and I thought at some point, people say go fishing where the fish are, and then preferably I would also like there to be no fishermen where the fish are. So I remember one of the first things I did, which I think defined a little bit my writing online, because people associate me a bit with Polish stocks, which is weird, of course, for a Dutch guy. But I remember looking up, and I think we didn't have ChatGPT yet, so it should have been Google, the number of publicly listed companies per country, and I think I divided them then by their total population. And Poland was very, very high, and I had never heard of a listed Polish company. So I pulled up one of the data providers and got a list of Polish stocks, and then it was like shooting fish in a barrel. There were so many cheap names, especially during the Ukraine war, etc. So that's a bit how I got started.
Very cool. Yeah, no, I mean, going back to your point about the YouTube stuff, I mean, like usually people find us after they've read One Up on Wall Street and really dug into the Buffett books and see that one line where he's like, "Oh, if I was a retail investor today, I'd be in small micro caps," and then they find us, after they've done the deep dive. But cool. So, I mean, what then inspired you to start the Substack? I mean, it sounds like you're kind of starting to dig a little deeper, but I mean, what then got Iggy on investing going?
Yeah, so I think what happened 1 year in is that his name slips my mind now, but the guy who runs the Bear Cave Substack, what is he called? Do you know?
Oh, Edwin, yeah.
Yes, Edwin. He hosted a stock pitch competition for students. And I was a student at that time, and I thought, well, that's a nice try or a nice opportunity. So I submitted a Polish nano cap called Monari Trade, which was exceptionally cheap. To put into perspective how inefficient the Polish market was at that time, and it's not become that much more efficient, but at least a bit more expensive. This company at the time was trading for 75 million Polish zlotys, and I just opened up their news flow, and it said something like real estate holdings sold for 80 million Polish zlotys. I looked how much of the real estate did they sell? Oh, only 50%. They also had an operating company running clothing stores, and that you basically got for free. So I pitched that stock trading for deeply below book, would receive its market cap in cash. Well, nothing would happen to its business. And that's how I started writing. Full disclosure, I've sold this stock by now, but it's still moderately attractive. But one of the first things I wrote about, and going into basically writing that article opened my mind to, it's both very, very useful to write about stocks because it helps you sort of clarify your thoughts yourself. Plus, it would just be, I think, very fun to get more feedback in public.
100%. And, the one thing that, when I first came into this, and I think, a lot of folks also experience is that, if you're really putting in a lot of work and time and effort into, putting yourself out there and writing and sharing your ideas, everyone on the whole is very gracious with their time and also provide really high quality feedback for the most part. I mean, especially if you're sharing, again, if you're putting in the work, even if it's an idea that's absolutely hated, if you're actually showing that you put time and effort into your thesis and really worked hard on like trying to understand what it is, like even the best of the best will be like, hey, maybe not a fan of the idea, but you actually put a lot of time and effort, and here's maybe where we can chat or learn from there or something like that. So I'm sure you experienced that.
Yeah, absolutely. It's my number one tip to anybody starting. You can do it anonymously if you don't like to have your face out there, but start writing or putting your ideas out somewhere because it's really, really useful. It will open up doors, new connections. You'll learn a lot. It will be painful, but I mean, no pain, no gain, right? So
just make sure you disclose.
True. Make sure you disclose.
If I'm going to put my compliance hat on, just disclose. That's the number one thing. So, I'm going to dig into the blog a little bit because there's a few articles that I want to dig deeper on that I really liked, and I had a couple follow-ups. But for you, just so that folks understand, I mean, you sound very much on the deep value, Buffett, that style. But what's an ideal setup, investing setup for you, so folks have a better idea of your philosophy and your strategy.
Yeah. For now, indeed, looking at my track record, I think it's deep history and deep value, and it might be deep value going forward. For me, that was a bit how I saw the times. I thought all these high flyer stocks seem a bit pricey. I don't know. I need to know a lot about the business to justify these valuations. So let's start digging in simpler stuff that I can understand. Maybe in the future, I find some stuff trading at 10, 15p that will grow a lot, and I'm very open to buy them. Just haven't found them yet. But indeed, for now, the sort of deep value setups I like the best are stocks that sort of go one step up over this Monari trades. Because this Monari trade, for example, deep discount to book, clear catalyst, etc. And that catalyst did partially close the stock price. But what I like best is actually companies selling below book, but where I'm quite confident that they will earn their return on capital. So that makes it for me very easy to hold the stock for medium long term. So a stock I still own is called Interlife General Insurance. I purchased it, I think, at 60% of book value, and it had compounded book close to 19% historically. So even if the future was a bit worse in the 10-12% ratio, if you buy it at such a deep discount to book, it's not that hard holding it. So that's, I think, what I like most. They're rare, but sometimes you just find something selling at a deep discount, which you think has an excellent history and no reason to believe its future will be different. So they can keep compounding or earning good returns and pay it out in dividends to you, and you'll be happy.
Absolutely. Hey, real quick, when it comes to your investing universe or the, where you like to go hunting, do you tend to stay European, or do you also look at US, Canada, all that stuff too?
Both. If I screen, I almost always screen Europe, because I just think if you go A to Z there's more opportunity. But I also do, I think, what most people do. I read Value Investors Club, I read Substack, I listen to your podcast, I listen to Andrew Walker, anybody else. If something in the US or Canada comes flying by that I like, I'll buy it. Something else that I owned in the past, for example, is Lee Industries. Not the greatest pitch, did make some money on it by pure luck, because there's, of course, a lot of volatility in listed equity stocks. But I've dabbled a bit in the US and Canada in the past. But if it's an original ID, so one I just found by going A to Z, it's much more likely to be Europe, just because I think it's more worthwhile there to turn over stones as a private investor.
Very cool. Yep. No. And by the way, Andrew's the man. Love that podcast.
So he also had a good mustache at some point.
He did have a solid mustache, and that, yeah, I'm sure you know how it is, the No Shave November. I'm sure it'll come back for November. I wish mine would look that cool. It's just like yours is like a thick blonde. Mine is just.
But I think you have very good growth. I think if you grow it out,
it's a wispy blonde. It's not a thick blonde on the mustache. If you catch my drift, it'll look more scraggly than it would be thick. Like you look like you're ready to go, like take over the high seas. Like mine would, like I'd probably be looking like I should be cleaning the deck, and that's not a good look. My wife would not like that.
Okay.
So
number one question for anybody who wants to grow a mustache, anybody will ask you, the first thing they see you with the mustache is, how does your wife or girlfriend like it? Number one question always.
I'm
so
sure.
Be prepared.
Yeah.
Be prepared.
Exactly. See, I always keep the beard, and then just it allows me to, be a little more nimble, like you go shorter beard, longer
Very
beard.
nice.
Anyways, no one really cares about it. But anyways, now let's get into the blog a little bit. You have this article that you just published very recently about, 11 stocks, 15 pitches, 2.5 years later. So it's kind of a reflection on, pitches that you put out there, all your writings from the last 2.5 years on Iggy, on investing, on Substack. The one question I had that I pulled up after, going through the article and whatnot, when you're revisiting a stock idea years later, and I'm surprised I've never asked this on the pod before, but I'm curious to your thoughts. How do you, when you're thinking about this, how do you separate a poor thesis from poor timing?
Hard.
Yeah. Dig it in now. Here we go.
Maybe I can start on the thesis, because I know when a thesis is poor, because one of the things, for example, I do in the article, which I sort of liked for myself, is looking at so how much have these companies produced in earnings, right? I say they're cheap, and were they cheap in the end? And in a decent hit rate, I think they were cheap. In 2 years' time, they produced north of 30%, for example, of their market cap and earnings. I think they are well below a 10 PE. I think that's a good pitch if I was kind of right on the fundamentals. Poor timing, hard to say. I know what good timing is. Lee, I had a bit of luck. I purchased something with a weird thesis, and some speculative buyers got in and pushed the stock up. I think on the upside, luck is very obvious. On the downside, it's very, very hard to say for me when the timing is wrong. It can be very frustrating. But for the thesis, to me, it's kind of easy, right? You have an opinion on what will the fundamentals of the business do. And if that's in the same ballpark as what you predicted, I think you can say you were kind of right.
I mean, overall, what would you say over the last 2.5 years, since you get going and really digging in, what have been some of the main takeaways, the main things that you've learned to help refine your thesis further? I know we only have an hour, but we can. We'll get it.
I was actually thinking about this morning. Many of the laurels for any of the new investors that people teach you are right. So stay in your circle of competence, 100% right. Any of the stocks that I've lost money on, I did a week of research. I thought, this looks cheap. And half a year later, the thing is down 50% because I understood nothing of where this thing was cyclical or what customer concentration really did to this company. So stay in your circle of competence is 100% true. The writing will help a lot with that. So also some of the names I lost a lot of money on, I was not confident enough to write up. And that should have been sign one that I should have sold. Other stuff, you can't make a good deal with bad people. My recent experience with Annexo, still hold a small couple of shares after the buyback, has really taught me that you cannot make a good deal with bad people. We can get into that because it's an interesting journey if you want. But many of the laurels that the big people like Buffett, any of the other value investors who do a lot of speaking teach you are true. So listen to them. Take them as granted wisdom because they're true.
Absolutely. No, that I hear that. I mean, what would you say was how your style has evolved, in the last 2.5 years? Like, what do you put a little bit more emphasis on when you're doing your deep dive research, or not, things that you thought were important, maybe that aren't important anymore. Maybe things you thought were important are actually like really important and you're putting even more effort into it. I'd love to hear more thoughts there.
Yeah, I think one of the things I realized in doing the write-up you spoke about all the stocks I did is in my deep value style, valuation matters, and it matters a lot. There's a lot of defense in depth, and then especially in the earnings, I think. Because I looked back at some of the stocks and I looked at my own prediction and I said, the stock trades for a forward PE of 3. Well, I was wrong. It turned out to be 6, so I was way off. But I mean, if the stock then trades to a P of 10, you made 40%, the 40% gain. So there's a lot of defense in depth if you buy companies cheap enough, which I think if you're not buying the greatest companies matters a lot. So if you can just search hard, far and wide and find very, very cheap stuff, that works, I think. Because you don't need to be that right. If something is 3p or 6p, you'll probably make money in both situations.
And it also seems like discipline is a main part of your process as well, right? Where you're just like, all right, it's up 30%. It's not like that great of a name. It has something interesting, but it's already, so it sounds like there's a mix of also figuring out like, okay, which one is truly like a long-term investment versus something that might be more of a quick trade, like not necessarily like day trading, but just, the idea, you get it, you see what's going on. Maybe it got, written up somewhere else. It, went up 30%. You're like, all right, this wasn't that great. Fine. I'll take my 30% and go on from there. If it goes up, great. If not, like, okay, I'm good.
Maybe one of the other big learnings for other people who are newer to this game, holding stuff for long term is much harder than reading it in a book. Because you see Buffett or somebody, if you read one of his biographies, hold a stock, it goes up 3-4x over 5-6 years. Reading those 2 pages took you 5 minutes. Living 5 years is very slow, very boring. And I think for me, the most painful stock with this has been a stock I've written a lot about called Card Factory, a UK retailer that has very good customer reviews. I think going 7-8 years strong, it's the number 1 value for money retailer in the UK. And it's one of these stocks that I found when I just started investing, trading at what I thought was, if COVID stopped, normalized PE of 3. So I thought, well, that's quite interesting. Took a small position because there was some risk they were going to delist, or not delist, dilute, because they were having a problem with their banking syndicate. Of course, they wanted to see more money. Well, at some point, they resolved the problems with their banking syndicate. So I thought, well, easy money, no chance of dilution. I bought a bigger position. And like I said, if you buy cheap enough, you make money. So it went from 3p to 6. But I think it's a very well-run retailer. I like this management. They prevented the dilution. They seem well aligned. The stock now has been flat 2 years on 6p or something. I still hold it. I receive big dividends, but I would have thought by now, reading the books, that the stock would be up, but holding it in real life is much, much more boring and much harder and frustrating than you might think.
100%. Iggy, how old are you, if you don't mind me asking?
I'm 25.
Okay, this explains a lot. I remember my mentality at 25. The last thing I was thinking about was like, oh, this is a sick investment. I'm going to hold for sure 10 years. You're like, right? I mean, I'm sure you've thought about that too. Like, how do you check? Like, okay, I'm 20. Like, all right, I'm trying. I like, there's so many different opportunities, and I want to just attack everything. But like, how do I mentally get past the like I'm 25 and just wanting to like go crush it and things happen instantly versus like, hey, this might take a bit of time for this thesis to mature, and it might go up little by little, and all that stuff. Like how do you check yourself behaviorally in that sense on the investing side? I'm not
to be honest, it's not the hardest thing I've struggled with. Like I've not been that tempted to sell. I've just been mainly frustrated. Like I'm cooking inside. Like, why is all this stuff going off except my stuff? I think some of the things that help is, for one, I'm 25. I'm not a full-time professional, so I have a full-time job on. Well, I wanted to say on the side, but I guess it's my main thing. So I'm not looking at the Bloomberg terminal all day, which might help.
Yes, that definitely does.
Otherwise, I think this writing stuff actually, both on the positive side, helping you hold stuff, and on the negative side, creating commitment bias. If you written about a stock 3 times, nothing changed, it's a bit awkward to go publicly like, sorry guys, found a new mistress flying off. So I guess on that side also the writing helps.
Definitely. Yeah, no, keeping a journal on all of it just to keep your head straight so you're not, especially if you're very confident with these, you've done the homework. Yeah. You're like, all right, this is one I want to hold,
I think that's the core. If you know the thesis well, if you're like, okay, 6p, but I think it's a quality company, it's also a comfortable hold, right?
Yeah. Oh, no, 100%. So, I mean, I think I forgot the name of the article but there was one that you talked about the concept of stag hunt. To describe shareholder dynamics. What does that mean? I've never heard that before.
If I want to talk about that, we need to go a little bit of context, and it's still a bit of an active situation. But what I can do is tell about one of my recent experiences in public markets, which might also be instructive to people.
Please, go for it.
So I have been analyzing a company in the UK called Anexo PLC. They do something very peculiar to the UK, where if somebody has a motoring accident and they are minimally insured, they can get a replacement vehicle, but they would have to fund it themselves. But they are not able to pay it themselves because they're called impecunious, which is a posh way of saying poor. And then these law firms come in that basically finance the vehicle for you and then sue the insurance party on the other side of the accident. So they basically help no-fault motorists get a replacement vehicle. They pay for the vehicle, they charge a rate for the vehicle, and they try to get it back from the other insurer. This is a bit of a capital-heavy business because while you put all this upfront investment in, you sue the other insurer, and it will take you 1.5, 2 years to get your money back. And well, this was one of those companies that we talked about earlier that I really, really like. It was selling at 0.5 times book when I started studying it, and it had been compounding book value north of 15%. And there were some big catalysts, I think, on the horizon in the form of a new business line where they did a similar model, but then for housing disrepair. And they had done, they have participated in claims against the big auto manufacturers with the Dieselgate. So basically they collected a lot of claims, and then at some point, Mercedes, Volkswagen, etc. will have to pay out Anexo a big sum, which was not reflected on the balance sheet. What was reflected on the balance sheet was a normal business, and this was deeply, deeply below book. Then your president did this little, what was it called? I want to call it Independence Day. What was the tariff day called?
I don't know. I blanked that out because it was 3 weeks before our conference in Vegas, and everything went to shit for a little bit. So I was just like, this isn't happening. Okay. We're erasing for your memory. But I think it was called was it Freedom Day or I don't know, Tariff Day.
It was something day, but something day happened and all stock markets tanked a good 10-15%. I don't remember how big
it was. Awesome. We loved it. It was so fun. It was great. It was great 2 days. We loved it.
Well, I had some cash, so I felt like a genius and bought this stock at 0.3 times or 0.3 times book. What happens 5 days after I buy the stock at 0.3 times book? A independent news outlet in the UK leaks that the majority owners basically the founders and a private equity firm that held 30% stake wanted to buy the company. Well, normally stock shows up 20%, you feel quite smart, but there was a catch. They were not paying in any form of cash. They just wanted to put no new cash into the business. And basically they leaked that you were either going to get unlisted B shares. So basically you lost your voting rights, you lost your public market access, and well, there you go, you're in a private equity vehicle. Or you got loan notes, another unlisted sort of instrument.
Interesting.
And this pissed me off, and this pissed off a lot of shareholders. And at that point I thought, well, I have this blog, let's see if we can get these shareholders together. So I started promoting on Twitter, on everything, to get these shareholders together. I worked sort of out this game theory aspect that you were mentioning. How can we block this bid? Because it's evil. So what I concluded is that if minorities can sort of coordinate in some form of manner, or at least communicate their intent to vote a certain way, we can win. Because for people who don't know, AIM has an incredibly low delisting threshold that sort of majority owners can hold over your head. It's only at 75%. You might know, Robert, what is it in Canada? It's much higher, I hope. No? Well, that's at least not 75%, because then some people would have tried.
Yeah.
For people who care in normal countries, it's 90. I've never seen lower than 90 anywhere else. And the insiders held 63% of the shares. So we needed around 20% of the total free float of the company to sort of win a delisting vote. And that also would have made it, without the threat of delisting, it would have probably been hard for them to force these unlisted instruments upon us. So that's basically where you get into a stag hunt. That's a concept from game theory. Everybody always calls everything a prisoner's dilemma. It is not. This was not a prisoner's dilemma. It's a different type of game called a stag hunt. And a stag hunt is a coordination game. So two hunters, they can do two things. They can either hunt a hare alone, which, well, it's kind of easy. You take your shotgun out and you can probably shoot the hare all on your own, and that has some positive payoff, say 1. They can also, together, go trekking, spend a day, and kill a stag, which you would then have to take back together, of course, for a much, much higher payout. This is a coordination game because you need to hunt the stag together. If one person goes hunting the hare, he will still have the same payoff. That's getting the hare. If the one hunter goes hunting the stag alone, he gets nothing. So it's a negative payoff. And it was the same here. If the minorities could work together, we could have sort of killed the stag, which would have been not being forced into this terrible deal. And if you act on your own, you would always get the same payout, namely the private deal. So this worked, I think, nicely in theory, and at some point we got up to very, very big numbers with shareholders sort of getting into our shareholder tally, etc. Because there was a nice list of big holders that you get out there with the Form 8K, it's at least a Form 8, I think, in the UK. And then plus a very big group of minorities that we found on Twitter. I think at some point we would have been likely to stop the vote. But what happened consequently, which is kind of sad, and we're still questioning the legality, is that the board approved a buyback for 50% of your shares. So not what we hoped, because if we pushed them for a full cash offer, it would have at least been a win for us. But it was a buyback structured where anybody could sell at least 50% of their shares. By the way, at a horrible price that even their independent financial advisor said this is an unfair price. I've never seen that happen in public markets, but Grant Thornton, the independent financial advisor, said this is not a fair price on any measure, and we cannot sign off on it, but the board did. It was, I think, 20% below the last market price. So this board, not independent, is a clear sort of case of poor corporate governance. But there was another catch with this 50%, is that anybody who didn't elect those shares could still be bought back from other shareholders. So basically, they structured it in exactly a way where they would get 75.1% of the shares and they could always win the delisting vote. So there was nothing we could do. They managed to scatter sort of the shareholder base. And in the end, we didn't win this fight. So for now, to me, it looks like the deal will go through. There are some other avenues that could still help us, but they're a bit late. Takeover panel in the UK could still intervene. There are 5 members of parliament in the UK who've written the Trade Commission about it, but for now it looks like the deal will go through.
So at what point when you're going through this process do you have to ask yourself, all right, is it worth it? Because I talk about that a lot with folks that, maybe didn't ever intentionally want to get into the activism game. And then now they're just like, yeah, like, well, yeah, we ended up, because it seems like in this case, it could go either, it's a lot of brain drain.
Yes, no, it took a bit more energy than it should. I think there my 25-year-oldness showed. I sort of just dove in head first and didn't reflect that much, I think, during the process.
Yeah.
And again, you have the same problem that I talked about before. Writing it helps you commit. But once I have a group of 100 minority shareholders with, we're going to do this, it's kind of hard to say, going on a holiday for the next half year, somebody else pick this up.
Or even just being like, all right, I'm dumping. Here's, I'll take my write off. Here you go, or not. Like it's tough when you're like fully pot committed and like it sounds like you're kind of leading the charge to try and get this thing not done.
Yeah.
Yeah.
No, so, it was another painful, but at least the experience where I learned a lot.
Well, that was that was going to be my next question. Like, what were some of the things that you feel like you really, took from this experience? Or, I mean, it's still ongoing in a lot of ways, but what have you learned from this?
What did I take for this? Like I already said earlier, you cannot do a good deal with bad people. Something Buffett says, what I said, his laurels are always true. I don't know if I was blind. I don't know if I could have seen this before. That's sometimes the hard part. There were only very minor clues to me that something like this could happen, although the private equity party in there was known to do kind of aggressive deals. So I should have paid more attention to the major shareholders. It opened my eyes a lot to the role of board members. I look normally at management and I say, well, since they've been here, they have excellent track record, good capital allocation, etc. I noticed in this case the board was supposed to protect us and they didn't, so I will spend a bit more time in the future looking at the board members. Do they seem truly independent, etc., because that was a very painful here. And another thing I took away, and I've seen this happen more often, with large private owners, there's no way they don't understand the buyback. They say we don't do this, we like the dividend, whatever. They always understand the buyback, but it only happens when the buyback is them buying back the whole company. Because that's what happened here. The shareholders, because the stock had been below book for a long time, shareholders had been pestering them in private, like just buy back some shares, because either you write one new claim or you buy back the shares and you're buying back 2 claims, so it's better. They understand why a buyback would be beneficial. They're just not going to do it unless it's them buying back the whole company very often. Same thing happened with Shinoken a long time ago. I think that was in 2020, 2021. Japanese company, a lot of value investors were in it. 50% of book, excellent track record. No buyback. Owner steps up, buys back the whole company. Yeah.
Yeah, it sounds like you're the moral of the story is like, if I don't have to do activism again, I'd be
true. On the other hand, it opened my eyes because I was surprised how many people you can get together. But I mean, there was a catalyst to drive people together.
And also, what's nice is too, like, I mean, this is kind of a maybe not necessarily an afterthought, but like, look at all like how much more of a community you've built probably by just networking with all these different people that probably saw the same thing, saw the same value. So now you have a whole network of other folks that you can always bounce ideas off too. Like that's worth it. Just the price of admission, at least a little bit there.
One other thing I learned from this, which is a bit about the market plumbing and sort of the inefficient market theory. What was very interesting to me was seeing that, because we had the share tilly at some point, right? And then we could see the owners own 60%. They think it's undervalued. Large holders think it's undervalued. They hold 19%. We have another 6% of smaller holders in this group. They all think it's undervalued. That means that whole undervaluation that you see in the public market is driven by the sort of 9% of people who are left, who are just trading these shares over and going everywhere. So it did open also my eyes a bit for how the market plumbing works and why indeed sort of auction-driven markets are so inefficient, because the stock price is not set by the 90% of people holding the stock who understand it well. It's driven by the 10% gambling on the stock. So it's kind of interesting to really see.
Very, very good. So, yeah, I want to close out with just talked a lot about experience here and lessons learned and everything like that. I figured there was the one other piece, or we talked about deep value frameworks, in your 2.5 years, and change getting into investing, for you, how do you avoid your value trap situations, and really like, okay, this has more substance versus just, it being something that I might get caught up in?
Yeah, how do you avoid value traps? I think
for you,
what we spoke. Yeah, for me, yeah. For me, it is a bit in this sort of track record of producing decent ROIC and capital investment decisions. So this Monari stock that I owned, it was my first lesson in, okay, if there's a discount to book, it can close a bit. But then also nothing can happen for 2-3 years because nothing is happening with the capital. You turn into a Japanese company. But if you turn over a lot of rocks, you'll find some companies that are cheap and doing useful stuff with the money they create. So if you buy cheap enough and it keeps compounding, doesn't even need to be at all that high a rate, you are sort of sure to earn some form of return, and makes holding much, much easier.
Very good. All right. Well, Iggy, I think we're pretty much there. We were talking offline a little bit about, you also host meetups where you are. So can you tell us a little bit about your local meetups and stuff?
Yes. So I was kind of jealous somewhere mid last year looking at you hosting events. I think Ian Castle hosts events. There's the big Berkshire meetup. And then to me, Europe is sort of like a desert on that front. I mean, could you name I know one other big.
I know ValueX does. They do.
Yeah, exactly.
Like Guy Spear, they're always doing some cool stuff.
Yeah, but I think those are invite only for fund managers or something. I don't think they're the easiest thing to get into. So to me, it felt like a bit of a desert for young guys or private investors like me to meet up. So I decided it's not that hard to rent a hotel and get some people together. So let's try. So we did the first one last year and it was a big success. Hosted a nice ID dinner after that where people pitched some great stocks. And then we're going to do the next one, the 27th of September in The Hague. 2 fund managers coming to speak. Sam Hollander is quite well known, I think, in the value investing community in Europe. And Jasper Brebaert from Value Squared, also a very, very excited fund who's going to speak. And then there will be many guys already know coming who are very smart private investors. So anybody interested in value investing microcaps, please come to these events. There are incredibly fun ways to meet new people, learn about new ideas.
Absolutely. No, that's awesome. I wish I didn't live so far. I'm in LA,
That's very, very far.
It's a little far, but well,
we had one American.
Listen, I will say this, don't get jealous. Just come, we're going to be in Toronto, it's a little closer,
Yeah.
And we'll be in Vegas in mid-June. So it'll give you some time to, organize. It'll be, you might listen.
Is there Ryanair to Las Vegas?
I think so.
I don't think so, but maybe Southwest, right?
At least to Iceland. You'll get to Iceland.
Exactly. To Iceland and then Southwest or something.
Yeah, exactly. But they're doing assigned seating now with Southwest, so you know what? You'll at least know exactly where you're sitting. It'll be fine. But cool. Well, Iggy, with that, where can our audience go and find more information to follow you on Substack as well as all your social media?
Yes, I'm Iggy on investing everywhere, so you can Go to Twitter, you find Iggy on Investing, not Iggy Azalea, not Iggy Pop, just Iggy on Investing. There will also be a link to my Substack, but my Substack is also iggyoninvesting.substack.com. There you can find all my write-ups, so the deep value IDs, you can find announcement about the events. And one other fun thing I do that some of your readers might like is I sometimes do case studies of public investors, which I think are very fun to do. That's why I do them, but I think quite useful. So one I did is I took all public letters by Smoke Capital. I just said, okay, what stock did he pitch? What was the ID and what happened afterward? And then I think it's a nice way to sort of learn about these grades in the microcap space. So if you're into that, also give those a read. I'm currently doing a whole series on Jeremy Raper. He started adding pitches after I started writing about him, so I don't know if I'm ever going to finish.
Did you write him and be like, dude, slow down a little bit, man? I'm trying to write a whole expose in a good way on you. Come on.
Exactly. No, but he started adding old pitches. He just took stuff that wasn't public, like, okay, Iggy, write about this as well.
Oh, he said, oh, cool. You're in contact with him? Because he's a great dude.
Yeah, he's very nice.
Very cool. All right, well, Iggy, thanks again for joining me. This was awesome. Really do appreciate it. And I look forward to having you on again at some point in the future.
For sure. Lots of fun. Thanks for having me.
Thanks, Iggy.